I've been hearing people say that the most obvious trades are the best trades since the beginning of my trading career. But I realize now that I didn't actually understand what they meant. Turns out that the key to understanding what the most obvious play was not knowing patterns, but more about the why behind it. One of the most crucial errors I made was not knowing that even though I may be watching a visual pattern set up, it may not follow through because it may not have all the components that it needed. Over time, I've started to think of trades kind of like recipes. If you don't have the correct ingredients each time, you're not going to have the same result across the board. Just like if you set your oven to a different temperature one time when you were baking your usual cookie recipe, you couldn't expect it to come out the same way as last time. Missing a key component or an ingredient in your play will possibly mean failure. Ingredients can include volume, sector momentum, news, time of day, daily breakouts, support and resistance levels, float, price, and so on. When I started trading, one of the worst things that I did was look too closely at the pattern. I was using a microscope when I really should have been using a wide-angle lens. All that squinting made my peripheral vision really blurry, and I had a hard time seeing the whole picture. My investigation and resulting plan often really was based on a 1 minute or a 5-minute setup. This was just far too close. At one point, I was even using tick charts to make my entries and exits. When I was trading this way, I could really feel the intensity of it. My emotions were all over the place. I was having a hard time because I was literally watching a candle turn from red to green repeatedly within the same minute. That kind of emotional triggering made it difficult for me to follow through on any of my plans. It was so bad for my discipline. That's why I would never do that today. I admit it took me an unbelievably long time to realize that I needed to take a step back and look at the daily charts to gather information for support and resistance that were really significant. A lot of what I was doing at the beginning was just hoping that it would go up and up and up no matter where it really was. Because of this mentality, I was really focused on my entry first. And a lot of the time, I didn't even really think about where my exit would need to be. That's really backwards from the way you should form your plan. You need to find where you would exit first. This is due to the fact that your play would be invalid at that point. From there, you can tell where the risk is really reasonable and where getting in would make the most sense. In the beginning, I hardly ever played dips, which is insane because really, you should never be playing anything other than dips. Even on a breakout play, you wait for a small pullback in order to get your entry. I was so hopeful at the beginning that it would just continue, so I just kind of jumped in wherever. I'd have to hold through a lot of chop and a lot of pullback, and all of those things could have been mitigated. All that stress could have been reduced if I would have just waited for that pullback in the first place. Think of it this way. When you're squeezing something in your hand, you can only squeeze as hard as you possibly can for a short period of time. But if you take a short break, you can go back to it pretty quickly. That's kind of the way that stocks move. If a stock is taking off, it's going to need a little bit of time to rest in between each squeeze. Back then, I also based my take profit points on whole dollars or half dollars. This was because they just sounded nicer in my head. Round numbers are emotionally appealing to all of us. Some people are so addicted to the idea of dealing in whole numbers that they can't stand having change on them. It's funny to watch people literally discard any change given back to them at a store or a restaurant. It comes down to not wanting to deal with it, and I think that that happens in trading as well. I didn't ever really consider at the beginning that a dollar gain for me from my entry may not be exactly at that whole dollar level. I began to win a lot more whenever I would put my take profits in before those big levels because I wasn't going up against so many people wanting to get out right there as well. When a seasoned trader speaks of whole dollar or half dollar levels, what they're really meaning is something very close to that. A lot of them say, hey, I'm going to get out at the half dollar, and the price that they really get out at is something like 47. That's close enough. This does kind of depend on what the price of the stock is. So if I'm getting in for the $2 break, I definitely want to put my take profit before that $2 mark. I want it to be at $1.97 versus if I'm playing a $22 stock and I'm going to $23, I can get out at probably $23.05 because it's probably going to push a little past it. Think of it this way, if there's weight behind the stock, and I think of it in weight in price, a lighter price stock would be $1 or $3. Those stocks generally won't break that whole dollar level immediately. So getting out a little bit before it will help you make sure to capture those gains. With a $22 stock, I would get out on the other side of it because the heaviness is in the price. And people don't really think once they have $22 in their hand that 3 cents is a big deal. I've come to understand the concept that knowing the psychology behind the other side of the trade will help you understand your side of your trade. So if you're a long bias trader, understand what a short bias trader would be doing in this situation. Always remember that the movement of stocks in the market are based on emotions, reactions to news, worries, and hopes based on the economy, significant events like earnings or strikes or maybe trial results, government policies and plans, laws, and wealthy and powerful people's words and actions. But this movement can actually be fairly well predicted if you can zoom out and look at other news events that are similar. When a stock has news and shows up on your scanner, take a moment and look at the news, then take a look back at the daily chart and see where it's moved a lot before. Look at the news for that day. Is it similar to the news that you're seeing today? You should also understand the market environment, at least generally. Sectors can actually move in both positive and negative ways, and it can affect your stock significantly. Sometimes the news on your stock is really great, but the sector momentum is in the opposite direction. Sometimes a stock's news can overpower a sector's weakness or strength. Often it isn't a great thing to gamble on. Volume was something I really didn't pay close enough attention to at the beginning either. I overestimated the power behind stocks all the time. I basically just expected everything to break out if it looked like it was making a pattern. This is because I didn't quite recognize where volume dried up or if it wasn't there to begin with. I'd recognize the physical pattern in front of me and I'd jump in because it was there, but that was before I'd realize there's like $1 spread, and I got myself into a lot of trouble that way. Remember that volume means that your plan is being backed by other traders. If nobody is paying attention to the stock, then you're not going to be able to get in and out of it without losing a lot to slippage. A canoe travels faster if there are more people paddling. I've recognized over time that the best setup on each stock is probably the first one of the day. That's because all the smart money is in there looking at charts pre-market, paying attention to movement, and creating a plan for themselves. They're likely to see the initial clear level like you do. In other words, your play will be backed by smart money that will push it to follow through. Most likely your play will also be backed by dumb money, and that will make it so that you have someone to sell to. I'm back because my video didn't finish yesterday for some reason. Hopefully we can stay on track. Let me give you a tip. If you find yourself staring at a stock for more than 5 minutes wondering what you can do with it, or if you ever hear the words "I hope" in your head whenever you're making a plan, or if you have to draw 4 versions of trend lines to make a pattern, or if you have to tilt your head and maybe squint your eyes to be able to see something up here, well, that means you're forcing a trade. If you stare hard enough at a stock, you're going to find something to trade. It's not going to be an A+ setup though, and in fact it probably won't even be B+ or C+. You can create patterns out of thin air because you're staring at it and logic seems to be coming into it because you're putting your mind to finding something. It's important to take a step back and get the bigger picture again. Especially if I've taken 2 tries on a stock play, I make myself in that moment step back because it's obvious that I'm just not seeing something significant enough. It's important to zoom out and really take a look at why. If you don't do this, frustration can kick in in, you can start to want to revenge trade. That means trying to get something out of it regardless of the fact that you've lost on it and you didn't read it correctly at the beginning. It's a very quick way to undo your progress. Overtrading happens when you see patterns and plays everywhere and you don't really have the discernment to be able to determine what the best plays really are. This shows up a lot in boredom trades. When you're sitting there at the market for hours during the morning, you spent a lot of time trying to analyze everything and find plays. You don't want to feel like you wasted your time. All of us have that instinct to want to pull something tangible out of the time that we put into a project. But if we're to be successful traders, there are some days that we should consider just sitting on our hands. That means not taking a trade at all. Maybe this is the way you get your income. In those situations, it's possible we put a little bit more pressure on ourselves to make money that day and therefore see something that may not be there. Always keep yourself in check if you're really striking out, if you obviously took a trade on something that you weren't feeling conviction in, make yourself get out and stop trading. If you're feeling any of these emotions, just remind yourself it's not fair to gamble with the money that you used your discipline to attain on something that really isn't A+ setup, especially if you know it. If you're feeling it in your gut that it isn't really a very good setup, it's probably because it isn't. A lot of us discount our gut feelings in this career path, but those can sometimes save us. It's better to quit while you're ahead. Honing the skill of recognizing an A+ setup does take time and experience. Paying attention each day to the things that create obvious and simple plays will help you complete your preparation faster and faster each time. You'll go from where I started, where it took me the full hour before market open to prepare my plan, to now I can look at a stock and be ready to trade or not trade it within 5 minutes. As long as you're paying attention and creating rules from what you see that will guide you towards the best setups, you'll find a process in no time that is smooth and simple. And most importantly of all, it will be obvious.